The critical hook. You've been told that compound interest is a magic wand, that if you just set it and forget it, you'll wake up at 65 with $1 million. But here's the cold truth. If you're starting with $0 at age 35, or if your money is parked in a low-yield savings account, that wand is broken. In fact, it's not even a wand, it's a leak. Today I'm showing you the 3 wealth leaks killing your retirement, and the 1 adjustment that can save you 10 years of your working life. The math, nominal versus real. Most people look at their 401k statement and see a 7% or 8% gain and feel like they're winning. That is your nominal return. It's the face value. But the number that actually matters, the one that determines if you're eating steak or ramen in 20 years, is your real return. To find your real return, we have to subtract the invisible tax, inflation. If your account grows by 7%, but the cost of housing, healthcare, and groceries goes up by 4%, your actual purchasing power only grew by 3%. Real return equals nominal return inflation. When you factor in taxes on the back end and management fees, a good year can actually be a break-even year. If you aren't accounting for the math gap, you aren't building a nest egg. You're just running on a treadmill that's moving backward. The strategy: moving beyond savings. Looking at the data, a lot of you are playing it safe by keeping the bulk of your capital in high-yield savings accounts. Hey Zeza, don't get me wrong, an emergency fund is vital. But as a long-term retirement strategy, it's a losing game. When you factor in that your high interest is taxed as ordinary income, your net gain often falls below the rate of inflation. To close the math gap, you have to diversify into assets that have inflation beta, assets that naturally rise when the dollar drops. Equities, stocks. Historically, these have the highest ceiling for outpacing inflation over decades. Real estate, REITs. These provide a hedge because as prices go up, rents and property values generally follow. Index funds. These allow you to capture the growth of the entire economy rather than betting on one horse. The goal isn't to take reckless risks. It's to stop taking the guaranteed risk of losing purchasing power in a savings account. The 1 adjustment in summary. So, what's the 1 adjustment that saves you 10 years? It's front loading. Because of how the math works, $1 invested at age 25 is worth more than $3 invested at age 45. If you're starting late, you can't just save more. You have to be more efficient with your tax advantages, like utilizing Roth conversions or health savings accounts, HSAs, to keep the government's hands off your real returns. Plug the leaks, minimize fees, calculate real returns. Don't be fooled by the nominal number. Diversify for growth. Move beyond the savings account. Call to action. The 401k math gap is real, but it's solvable if you stop thinking like a saver and start thinking like an investor. Understanding how to grow wealth is only half the battle, though. You also need to know how to use debt so it doesn't use you. Check out my recent short on good debt versus bad debt to see how the wealthy leverage capital to accelerate this entire process. Stop saving for a maybe retirement and start building a certain one. I'll see you over there.